Hi, welcome to a new episode of ILANOMICS. This episode is coming live to you on the day the Reserve Bank of India has cut interest rates for the fifth time this year. The talk in the last few weeks has been about fiscal and monetary measures going hand in hand to try and boost growth because the slowdown does not seem to be showing any signs of halting. The one big expectation that the government and the markets and industry, everybody has, is to revive consumer demand. I have Professor Ila Patnaik with me, who will talk about the steps RBI has taken today, the announcements, the bad news of pulling back on the growth projections. And is this enough to revive demand, or what more can be done, what more needs to be done? And what is at the root of this hesitation among consumers to go out and spend as the government and industry wants them to? Ila, welcome. 25 basis point cut. Nobody's surprised by that. What is your first thought on that?
Yeah, I think it was expected. The economy is slowing down, and in fact, the signs of slowing down have become worse than they were when the last 35 basis point rate cut was done. So this was pretty much expected, and in fact, very much needed, because this is a time when, you know, you're seeing investment demand has been slowing since 2012, and now consumer demand is slowing. So whatever you can do. I mean, there are many other steps that need to be taken. This is only one of them. But yes,
But you do agree that both the government and the RBI are being quite aggressive now?
it does appear that they have understood quite clearly that you are in the downturn of a business cycle, as well as there are structural issues with the economy. So you need to have counter-cyclical fiscal and monetary policy. That means more expansion than you would have done had it been just normal times, as well as do structural reforms. So the sense one gets from, the corporate tax cuts and the continued interest rate cuts is that we are going to see counter-cyclical macro policy.
For the fourth time, the RBI has cut the full year growth projection from now 6.9% to 6.1%. That seems a little drastic. Excuse me. And also, it has spooked the markets. Markets are, taking it badly. I wouldn't call it tanking, but the mood is very low today after the announcement. 6.9 to 6.1. Does that shock you?
Honestly, I'm not surprised. In fact, though GDP numbers have been looking still okay, but if I look at the other indicators, and I've been saying that I think for the past 6 months, and maybe a bit prematurely, but the other indicators were indicating this downturn. And, this means that maybe direct tax rates for income tax as well need to be cut. GST rates need to be cut, because you do need, when you're having such such a sharp slowdown that we are seeing, you do need to think about how the economy can at least be stopped from going deeper into a recession. Remember last time we were talking about how this Diwali sales had better pick up, because if investment wasn't already happening, sentiment has really been down for quite a while. If consumer demand also starts falling, and this would be the second consecutive Diwali, if things don't pick up this time, that you would see a slowdown, then investment demand will perhaps not pick up for a much longer time. So that's the danger.
Your latest ILANOMICS, which you wrote today and we published earlier in the day, talks about consumption and the lack of consumption demand growth. And also, you have probably hit the nail on the head by saying that the Indian economy is going through a transition, and the formalization process of the Indian economy is probably what lies at the root of this slowdown. And you have also talked about GST being that point where the changes started coming into force. Now, after it's more than 2 years since the GST was introduced, where does that leave us after 2 years?
So this is a very complex process. Let's just try and think about a firm that was in the formal sector, producing consumer goods, maybe biscuits, competing with the informal sector. So initially, and that's what we try to look at firms like Britannia, ITC, and we see that initially. When GST was introduced, because they were already paying taxes, they were complying with the system more or less. So those firms didn't have such a big cost of complying with the new GST. So we find that they, I guess, did better than their informal sector competitors. We don't have data about their informal sector competitors. We only have data about the formal sector firms. So they did better then. But, after that high growth, when they were perhaps gaining market share, after that period of high growth, if the total market started shrinking, because the informal guys were not just one or two, were not just their competitors, but were pretty much a very large part of the economy. If 95% of labor force is employed in the informal sector and that sector is shrinking, then the total pie, the market, size of the market shrinks. And it seems that that's what has started happening now. And that's a very long process. 2 years doesn't mean anything. So what is the process? What needs to happen for the market size to grow again? New firms need to enter, or the old ones need to expand, those which are capable of paying, let's say, a 12% tax. So they have to be more productive so that they are able to comply with the GST. If that happens, it doesn't happen overnight. It takes time to happen, that firms become more productive, grab market share, and then we will see a formalization of the economy. So this transition from an largely informal economy to a formal economy, which the GST kind of creates conditions for, is a very, very big structural change in the economy.
You have called it a disruptive reform. And this is something which experts have talked about in the past as well. And in other countries, other parts of the world where GST was introduced, it did cause disruption. But was it so bad from what you know? And was this something that could have been factored in?
See, we had two additional problems. One was multiple rates, a high GST and multiple rates. And the second was compliance, difficulties with compliance. So in addition to all the problems that one would have had we just introduced, even if we had introduced a perfect single rate GST, even that would have meant that formal sector firms were better off than informal. By formal, I really mean those who were already tax paying. Okay, those firms would have been better off than informal sector firms already. But now, in addition to that, we have these two big problems. So I think we were worse off. The pain was very bad, and the rates were high. Look at how rates have been cut after that. Simplification has been done, rates have been cut. But this is again a period of, going from one equilibrium to another equilibrium. It is a period of disequilibrium. It is a period when constantly you will see the share of the formal sector grow while the share of the informal sector collapses. And then till you reach a point where the entire sector is more or less the formal sector, tax-paying sector, let's say till everybody is paying taxes, it will be a period of transition and you will not be in equilibrium.
Ila, we have questions coming in from our viewers, so let's start taking questions. Pradeep Joseph asks us, is the drop in demand because of global factors? and other tax rate cuts that have been announced by the Modi government is just a way to keep people happy? And how will these tax rates actually help entrepreneurs?
See, these tax rates means that your post-tax profit is higher. When it's a tax on corporate profit that is reduced, then the post-tax profit rate goes up. If your post-tax profit is up, it is incentivizing you to invest so that you get returns and then those are not taxed that much. I don't think it's going to push demand so much because the problem that we are seeing today is consumption demand decline. And investment will responds both to the post-tax profit rate, but very much to demand conditions. So today, for encouraging demand to increase, for investment to increase, you also have to encourage demand to increase. Had this been done in 2015, say, when investment was slipping, so from 2012 investment started slipping, if it had been done then, when there was no consumption demand problem, it would have helped much more. But today, consumption is slipping. You're not at a stage where just with this step, you'll be able to get demand back.
Pradeep also has another question. Ila. He says he's referring to the interest rate cuts today. Will these cuts be implemented in all the banks? Will consumer benefit by this? And how many more rate cuts can we expect?
See, we're not seeing much transition of interest rate cuts.
You mean transmission?
We're not seeing much transmission of interest rate cuts. Primarily, I believe it's primarily because we don't have a competitive banking system. So it's not that banks are competing to give loans to consumers. It's not that because they can borrow lower, they are able to go ahead with lending cheaper as well. So I don't think that that too many banks are going to cut rates too much. I'm sure the RBI will step in and say, you have to cut rates, you'd better cut rates. But that's something they've been trying all along. And maybe some rate cut will happen. Of course, we hope it does. But I'm not sure that the entire drop will, benefit consumers that much.
Nikhil has a question, Ila. He says, apart from the rate cut, has enough been done to address the crisis in NBFCs, and now we had issues with cooperative banks?
The issues with NBFCs and cooperative banks had a lot to do with the fact that RBI has very weak supervision. This is something that should have been addressed long ago. It has been pointed out. You look at the number of public sector banks that went into the prompt corrective action framework, even private sector banks that had various governance issues. Many of their MDs, CEOs were changed. But that doesn't solve the issue of weak supervision by RBI. I think the question we need to ask now in this country is, why is the banking regulator suffering from this weak supervision? And perhaps the answer lies in the fact that, most of the banking sector is public sector banks. There is a moral hazard problem, if I may use economics jargon, that, that the bank is not going to be allowed to fail. Whether I supervise it well, whether I supervise it badly, even if I find that a core banking system of a bank is not talking to its SWIFT, which is what happened with Punjab National Bank in the Nirav Modi scandal, then also, yes, I talk about it in a lecture that I'm giving at a university, but as a regulator, I don't actually go in, check systems, and stop it then and there. So that's a moral hazard issue that the regulator hasn't really had to do good supervision. And then it's today perhaps lost the capacity to do it. It does not have that adequate supervisory capacity. So we're seeing this now being reflected in NBFCs, which it doesn't particularly regulate or supervise as much as it regulates banks. But obviously, so it will be even weaker here. and even weaker with cooperative banks, where its supervisory capacity is very limited.
Ela, you have talked about tax cuts. The government has gone for a corporate tax rate cut, but not in the personal income tax. We are in the beginning of that, festival season, where you wanted to talk about demand being pushed up, and the festive cheer coming back, and that will be the crucial period for seeing how consumption comes back. And we just started, so I don't know how it will go for the next, say, fortnight at the most. If it I mean, I'm trying to be hypothetical now. If demand doesn't come back, what happens next? Does the government need to do much more, or what more can the government do? You have talked about giving it time. You have talked about being patient. I saw some other analyst comments today talking about both the fiscal and monetary sides have done quite a bit now. If they do anything more, there is a danger of overheating the system, and that could lead to very high inflation. What are your thoughts on that?
I think we've fallen into a trap of thinking that a flat rate of fiscal deficit is the best thing for the economy. That there's something holy about 3%. Not too many people who are advocating 3% even know where this 3% number came from. But, I mean, all of basically macroeconomics is about business cycle and counter-cyclical macro policy. A 3% rate has nothing, a 3% fiscal deficit has nothing, there's no, sanctity. Yeah, it's not sacrosanct. So that number should not be taken to be that this is the rigid line. But it should not be that we just keep going in one direction, that from 3 to 4 to 5, but that we have to put rules in place that give us counter-cyclical fiscal policy, so that when times are good, it goes below 3%, and when times are bad, it goes above 3%. So just looking at, oh, this is the number, and is it good or is it bad if we do tax cuts? It is bad. I think that is a wrong understanding, because I know I'm repeating the word counter-cyclical macro policy, but that is the role of fiscal and monetary policy. The way we don't say that 4% repo rate or a 7% repo rate is the rate that we'll have. We adjust the rate according to conditions. Similarly, the danger here, of course, is, and I agree with people who feel scared about it, is that governments will just do runaway borrowing, that it'll keep going in one direction. But do remember, that's not happened. Okay? One of the reasons it hasn't happened is because we are an open economy. When we do high fiscal deficit, it spills over onto the current account deficit. We get a depreciation, and people wake up to the fact that you can't just keep going in this direction. So in short, to summarize my argument, I think at this time we should not be thinking of 3% as sacrosanct, that we should be thinking that this is an economy that is going to find it very hard to pick up, because it could be a very long transition process to a formal economy. At this time, I think the additional things the government needs to do is reduce regulations where it can, and ease conditions, ease of business in its true sense, for people entering business, for new firms, for firms to expand, so that the productive firms or the formal firms can actually grow. Otherwise, you'll have the informal dying and the formal dying, and then you're in deep trouble.
No economy left.
Then you're in deep trouble.
Thank you, Ela. Thanks for watching this episode of ILANOMICS, which came to you live. We will come back with another episode next week, along with Ela's column ILANOMICS. Do read that in theprint.in, and also keep watching ILANOMICS and subscribe to our channel. Thanks for watching today.